All right, welcome everyone. Looks like we're right on time today. We've got people joining us still, so I'll give it just a second, but looks like you're able to see my screen okay, and I believe you can hear me okay, just checking that my mute is not on, although that's happened a few times before, and luckily I catch that. And we're going to talk about getting the most out of ThetaTrader. If you've seen a bit about ThetaTrader before, maybe you've had a demo account in the past, this will be a good review for you and then give you sort of the ability to take action and get started afterwards. If you haven't seen this before, there's a lot of great information ahead. We're going to do a demonstration and some simulations. We're going to look at how to trade option spreads in a unique way. We have a proprietary solution. We're going to look at an overlooked stock index, and we don't have to screen watch. This is not day trading. We're going to use automation to help manage our trades for profit and risk. Do take a moment and look at the risk disclosure before we begin. Thanks everyone for joining. I see people still joining us. Keep in mind that when trading and speculating, you should be using risk capital, and that past performance is never a guarantee of future results. Because remember, we are speculating and we are accepting risk as we speculate, hoping to profit on price movement, whether that's up, down, or sideways. And just a little bit about AltaVest. We've been doing this since 1997 as a brokerage firm. So it's 27 years plus of trading millions and millions of contracts along the way. That's yours truly there, and some of our colleagues and partners. And some of these guys here were working with us on the floor trading options at the S&P 500 options trading pit. We had a team of people actually working for us, filling orders and executing for us. So everything is electronic now, so that is no longer the case. We are the creator of the Dragonfly, the option strategy. If you've never heard of it, that's okay. We'll review that, and our proprietary order execution technology, something you can't find anywhere else, and we'll show you why that's important. And clients have traded millions of contracts with us using our solutions. We're registered with the CFTC, member of the NFA. We're located in California. And a little bit about myself. I'm Eric Gebhardt. Been doing this about 33 years now. Back in 1991 is when I was licensed. I graduated from the University of Southern California with my degree in business administration. I got started way back when with mutual funds and annuities. I have my Series 6 and 63 securities licenses, and currently have my Series 3 commodity futures license, as well as my Series 65. That's the investment advisor law exam. Okay, so with the introductions out of the way, I'll go ahead and turn off the camera. That'll give us more room on the screen. You don't need to see me the whole time. So how many of you can identify with these three barriers? This is based on feedback we've received over the years from clients. Just a lot of noise, conflicting targets, opinions, narratives, too many choices. Here's an example of an option for just one expiration. Here's a series of strike prices, and how would you even know which option to choose and select from, let alone how to build a spread? And then price predictions. I left this one in. It's a little bit dated, but this is from December of 2022. This guy says Bitcoin will reach 250,000 or it will go to 5,000 in the next year. So neither one of those things happen. I'm not criticizing him in particular, but just pointing out that I'm not sure there's any value at all in such claims. I think they're just getting lots of attention and clicks that way. Here's the price targets. We'll see what happens here, but the S&P, of course, is above all these price targets from some of these major firms at the moment, but we'll see what happens at year end. But again, you have such a wide diversity of opinion. Where do you begin? Who do you listen to? Who do you avoid? Kind of a difficult thing to know and determine. The second barrier, how about just time? And we've seen kind of images of a person like this sitting behind their desk, and they probably have a life to live, and they're not really willing or able to sit behind a screen for 6 or 7 hours a day or longer to prepare ahead of time and regroup and so forth afterwards. So it's hard to do, hard to find the time. And then how about the third barrier is just us? Our human nature is what it is. We have fear and greed running through our veins. We ride these emotional roller coasters. I thought this was a good depiction here. As you're doing well in the markets, you start to really feel exuberant. You feel great. You think you're really smart. And that's really the point of maximum risk when you're overconfident. And, as things turn the other direction, you start to feel a little bit despondent, discouraged, and maybe you throw in the towel right when you shouldn't have. And sometimes that's the point of maximum opportunity. What is it? You should be buying when there's blood in the street, so to speak. Is that what from a quote from Rockefeller, I believe? So you have to control your emotions, and hopefully we can use some mechanisms to help you do that. So we can trade options like a large institution, and we're going to show you how. Let's give you an example of how these bigger entities do it. Like an insurance company might, they're simply looking to get paid to assume risk. They sell and manage time. They're insuring themselves all along the way, so they're always hedged. And then they're consistent and they're patient in their process. And they use math and probabilities basically to favor them in the long term. Statistics, actuarials, you understand kind of what they're doing behind the scenes. But maybe we can collect premium too, sort of like an insurance company might attempt to do. We like to get these base hits by selling options and collect premium. We need to be consistent and patient. We'll manage the losers along the way, manage reward as well. That's just as important. You can use some experienced coaches, probably something that a lot of people wish they had, someone to sort of get some feedback and use the correct tools. So again, these are not going to be grand slam type of trade setups, although you could use options for that, but that's more of a few and far between type of approach. So these are short option strategies to collect premium, non-directional bullish or bearish strategies, targeting outcomes with fixed risk and profits. They're called credit spreads. Each position is insured with predetermined risk and reward. They could even be non-directional in nature. In other words, we're not necessarily always trying to determine if a market is bullish or bearish. Before we dive further into the demo, let's look at some of the Greeks, as they call it, the options terminology describing some of the characteristics of, went the wrong way, of options. So the first would be delta, and that is simply what it says on the screen. How much does the value of the option change with a change in the underlying asset? And it's the approximate probability of expiring in the money. That's another way to view delta. And here's an example of delta is 0.25, and there's a 25% chance that expires in the money, but conversely, a 75% chance it would expire out of the money. And of course, delta is always something that's moving with price and time, and it is not the probability of a winning trade. So it's important to keep that in mind as well. And then theta is the other Greek that you need to know, and that's just a function of time, sensitivity to time. Remember, an option is a wasting asset, and it has an expiration date, limited life. So theta is usually a negative number, equals 1 day of time decay. So if an option premium is 10 points and theta is negative 0.05, that means the next day the premium would drop to 9.95 in value, and the next day after that 9.90, and so on and so forth. And this is sort of what it looks like on a graph. As you approach time zero, the amount of the premium remaining or percent of the premium drops and drops and drops, and that's due to just less and less time on the calendar for the option to become valuable. So Wall Street pros, they also trade options, but they also do it differently than most people, or at least most retail traders. They're trading multi-leg option spreads to collect premium. Here's this woman here. She says an option spread calls for buying and selling different contracts. It's a very common way for investors to hedge risk and volatility, and it's usually cheaper because you can offset your cost by the proceeds from different contracts. And she's absolutely correct. And I quote her later, I forget her name, but you'll see it later. We're going to revisit her again in just a bit. And then she said it's been used by Wall Street professionals for decades. And she's absolutely correct. So what about as humans, can our emotions compete with the algos out there? And we've all heard of algo trading, systematic trading, high frequency trading, mechanized trading, you name it. This is what really your competition is. Everything is now algo driven. In fact, JP Morgan estimates 90% of US equity trading volume is systematic trading, machine driven. So can we use algos to trade options and option spreads? Yes, we can. So we can use automation to hopefully collect option premium, and we'll look at some of these unique strategies, whether they're bearish or bullish or non-directional. We'll probably focus more on a non-directional approach today. And here's an example of selling an E-mini S&P 500 call spread, and we'll get into why we look at the E-mini S&P 500 in particular. But really, the answer in advance is that's where the volume and liquidity is. But here's an example if you're bearish or moderately bullish or just have a non-directional bias. And here's an example where you sell this red line as a call and you buy the blue line as a call. And the net result here is you collect 2.25 points or $112.50 per spread, minus any commissions, of course. And that's the net credit on that position. And you want the market to stay essentially below or fairly low, fairly much, I should say, lower than this line in the sand, this red line in the sand here. And here's a inverse of that, selling an E-mini S&P 500 put spread. So you would do this if you're bullish or moderately bearish or have a non-directional bias. So just the opposite of what we looked at here. You sell this out of the money put, that's the red line, collect 3 points. Same time you buy an out of the money put below it as a hedge or protection. You have to pay money for that insurance or that hedge. So the net result is you collect 2 points or $100 in this hypothetical example. But this is a good visual. And you can see that, along the way, the market's chopping around and going up and down and up and back up again. And this is the kind of thing where we're going to show you with ThetaTrader and how ThetaTrader handles that. These are not naked options. So again, every sold option is covered with a bought option. So that means your maximum risk is capped in advance. These are covered spreads. No naked trading allowed, folks. And that means there's no unlimited risk with each of these covered positions. And really, there's going to be no margin calls if you have just a covered option spread. So that's important. Here's a bit of a joke. This woman's looking at her phone. I guess it's his phone. And she says to him, "Who is Margin and why does she keep calling you?" So you want to avoid the types of strategies like selling naked options where you will assuredly be on margin call. So here's the first spread we'll look at in the demo here, the Iron Condor. It's really the combination of the put spread and the call spread that we just saw. Just a simultaneous order to sell an out of the money call spread and sell an out of the money put spread. And you collect net premium on the calls here and the puts here as well. The net result is you collect premium on both sides of the trade. And you can see the numbers in this example. And then here's an example of the market moving back and forth, staying within this wide margin here between the sold call and the sold put. So, here you have the Iron Condor with a non-directional bias, and then why would you do this? Why is it a worthwhile consideration? Or how would you even go about getting out of the trade? Well, because after theta decay works its magic, this is what happens. You can see here the market's moving along, and right here where this arrow is, ThetaTrader gave a signal to close out the position. So when it turned blue, that means take profits on the position and buy back your spread. So you sell the spread for a certain amount of money, and then right here is when you would buy it back for less than what you sold it for, and then therefore That's how you generate your profit in this example. And we do not ever suggest holding these types of things till expiration. So ThetaTrader will give you signals to get out, whether it's for a profit or a loss. And then here's the kind of the weird strategy that some people have called it, but I think that's a term of endearment is the way I look at it. And it's really just a variation on the condor. It's called the dragonfly, and it has 6 legs. And it's also used to collect premium. So it's really the proprietary variation we came up with for collecting premium. So it looks similar to a condor, but with 2 extra legs. And here's what it looks like. And right now it looks kind of complicated, but it's really not. You sell 4 calls, you buy 3 further out of the money, and then 1 closer to the money. Then you sell 4 puts, you buy 3 further out, and then 1 closer to the money. And then the net result is you collect premium on the puts here that you've traded and on the calls that you've traded. And then so what happens is after theta decay works, the market's moving along, and then again, you see this blue arrow. This is when you buy back the spread, when the signal came in here and it turned blue. So you've sold it for a certain amount of money, and then you buy it back for less than what you paid for it. Or I'm sorry, less than what you received for it. And of course, the trick would be, how do you know which options to trade? And that's what we're going to look at. Before we jump into that, one thing I wanted to point out too is we talked about briefly, one of the bullet points on the introduction, I think, was an overlooked stock index. And everyone looks at the NASDAQ, of course, but also the S&P. And I don't know why people still pay much attention to the to the Dow, but anyway, they do. But the index, like the S&P 500, you think 500 stocks, it's going to be really fully diversified, but it's really not as diversified as you might think. I want to point this out here. It's just from a couple weeks ago, but it's still relevant. First quarter of this year, S&P 500 earnings growth. If you remove 5 companies, NVIDIA, Amazon, Meta, Alphabet, and Microsoft, if you remove those 5 companies from the S&P 500, the S&P 500 would have negative 6% Q1 earnings growth. Think about that. So here's what it looks like. Negative 6% without those 5 companies. So 495 companies remaining in that index still have negative earnings. Then here's the equal weight S&P versus the S&P 500. So if those big 5 tech companies didn't have such a large weighting in the S&P 500, here's the difference in performance. Big difference here. In fact, I think you can see here, I think that spread is probably about a 10% difference in performance. So we're going to look at the E-mini Russell 2000 as well. And remember, that's a small cap index, and there's no big tech in there. So that means there's no really 1 or 2 or 5 companies that are overwhelming the index and influencing it. You have a lot of financial, banking, energy, smaller cap companies in the Russell 2000. So here's the blue line is the S&P 500, and here's the Russell 2000. And what I want to point out too is you can see that there's definitely a difference in performance, although there is some correlation, of course. But again, you have the S&P here up, I don't know, near 10%, and the Russell, what is that, 3%? So the Russell at the moment is just a little bit quieter. It's a little bit, it's more of a consolidating index at the moment compared to something like the S&P, which has an overly influenced amount of direction from the big tech companies. So here's volatility on the Russell down around 17.8, and here's volatility on the S&P right around 12. So essentially that's a representation of no fear in the market at all with the S&P, and that's because of the overwhelming influence on those big tech companies just moving it higher and higher. So there's a bit of an arbitrage opportunity here between this volatility and this volatility. And essentially what it means is we can capture more premium out of the Russell right now and do it with less margin. So we're going to show you that. But look at this, Russell 2000 earnings, year-over-year growth down 17%. So again, just that disparity between the handful of large tech companies compared to a much wider dispersion of stock market performance. Pretty interesting stuff. So we can look at unique bullish and bearish strategies too. I'll briefly touch on that because ThetaTrader can do it all. But first of all, how would you know how to create a spread, which market to use, which strategy to apply, at the correct price? What's your timing on your entry, and how do you manage the exits for risk and reward? So the answer is ThetaTrader. So these are pre-built option spreads. We create theta trades every day. These are those professional style option strategies for any market condition. And then we use automation on the risk and profit with something called the RTI, or the risk thermal indicator. All right, I'm going to switch screens here, so give me just a moment. We're going to jump into the demo. Here we go. Okay, can everyone see the screen okay? I believe we can. So I should, let's see, I want to double check. Okay, good. This is the ThetaTrader dashboard. And you'll see the top section here is for theta trades. These are your open, short, or sold option positions, any long or bought option positions. And then over here to the right would be your account info. And all this is integrated with your AltaVest trading account. So ThetaTrader is our software that we developed. AltaVest developed this software, and it's only available for AltaVest clients, of course, because it's our proprietary solution. Then here's current price quotes over here. This is a demo account I use for webinars and just basically demonstrations, whether it's live or recorded, either way. So you can see here you've got your theta trades, you have bullish, you have bearish and non-directional strategies that are pre-populated. And then we have three markets we're looking at: the E-mini S&P 500, the E-mini NASDAQ 100, and then the E-mini Russell 2000. And you can click on any of those markets and see the various strategies available, whether you're bullish or bearish or neutral, like I said. So why don't we look here, since we talked about dragonflies. Let's start off and we'll look at an S&P 500 condor and compare it to a dragonfly. So here's the July week 3. So this is what it looks like on the graph, sort of a helicopter view. Here's the current market price, and you're selling these 5710 calls and 5010 puts here. So 700 point difference, kind of your margin of error here for the market to move up and down on this particular trade. And we'll go back and look at the details. You can see it has 59 days till expiration. You've got settlement value 2.2 points, the net premium, your put risk, call risk, commission, available capital, cash required, profit potential, targeted return on cash, and then your targeted annualized return. And remember this here, or I should point out this targeted annualized return, this number is really to compare one trade to another. It's not to suggest you're going to make 60% a year by just placing this one trade. So just want to point that out. But you'll notice here cash required is $911. profit potential $89 on this particular example on this condor, and the puts that are being sold, the 50-10 strike, the calls, the 57-10. Let's look at these a little more closely. A 9.91 delta, that means there's over a 90% probability this put is going to expire out of the money. And with the calls, 6.99, so you've got about a 93% probability that these calls that you're selling are going to expire out of the money. So these are mathematically a very much more of a higher probability outcome that favors a seller. So that's why you see that the algorithm is deciding to sell these puts and these calls, and then you hedge it with the purchase of these puts and calls here. And that's really the reason why these are considered you're collecting premium. These are short option strategies, and these are what you would call base hit trades. So you're putting up a little about $900 to make about 90 as a maximum profit potential, and the reason you do that is because of the deltas here are suggesting that's a very high, mathematically high probability outcome in your favor. So it always defaults to 1. And if you change here, you can see the numbers changing. We'll just do 5 of these and just act like we're selling 5 of these. And we'll go ahead and place that order. And you can see there it is. Just assumes you're filled in the demo account here. Selling there at 5. So that's the Iron Condor. Now we'll look at the Dragonfly. Okay, look at the Dragonfly. I don't know why sometimes during a webinar it moves a little bit slower than normal. Any day now. If not, I can just refresh the screen here. Okay, that took a while, but in any case, so that was a condor on the S&P 500. Let's see here, where you can see then it shows up down here on your open short positions, and that's the week 3 S&P 500. Then we will look at the week 3 Dragonfly. So there's the structure for the Dragonfly. Remember, we're selling 4, buying 3 further out and 1 closer to the money. And the algorithm basically decides on the strike prices and what the distance is between, for example, this call and these calls that you sell and so forth. And it's not always, in this case, it's 50 points, but it's not always 50 points. It can change at times. And really, the key to the Dragonfly is this call you buy and this put you buy. And let's just use the call side as an example. If the market moves higher and higher and higher, this call here that you've bought, you own it, and it has a higher delta compared to the others that you sold. And so therefore, it's going to gain in value much more quickly than the other strikes that are further out of the money. And also theta decay won't adversely impact it as much because it is closer to the money. So it creates a totally different characteristic compared to a condor in certain circumstances in particular. So that's why we like the Dragonfly. And you can see all the different details here in this table, but you have about $4,700 over 47, let's say 4750 cash required to make a maximum of around 250. And of course, it's a much higher maximum profit target because you sell in quantities of 4. 4 puts and 4 calls. Then you can see your targeted annualized return is less compared to the equivalent condor, and that's simply because you paid money to buy this extra insurance here and here. So that creates a slightly more risk-averse trade, and there's a cost to doing that. You can see the deltas here on the puts and calls are the same because it's actually the same strikes that the algorithm chose. And we're selling here. We can do maybe 2 of these. Your cash required goes up, your profit potential goes up, and then we'll place that order. And there you go. It just assumes that you're filled, and it's just that simple. But what I want to do now is let's look at the Russell. So bear with me here, folks, as we move into the Russell. This is moving a little bit slower than normal, which is unfortunate. Sorry about that during during the webinar. And you can see too that depending on the market conditions and depending on the strategies you're looking at, whether they're bullish or bearish or neutral, or even the market or the indexes here that you're looking at, you may have 10 different theta trades to choose from on any given day in terms of a dragonfly. You may sometimes have less. You might have a few more. It just depends on really what the machine generates in terms of its output, and that's all dependent on market conditions and all the variables that it is considering. I can also point out one thing here. You'll notice that open short positions, and I'll explain these colors in a moment, but essentially green means good, do nothing, and yellow is slightly elevated risk. But you can see the difference between the open or the short option positions and your long option positions in terms of the odds of, I guess you could say, success or probability. These are much more lower outcome trades down here, probability wise. And you can see that we're in the orange zone on 2 of them, which is highly elevated risk. Yeah, I don't know what's going on. Give me one more second here to refresh this. And then we're going to look at a Russell real quickly. Then I'm going to show you sort of what we call the time machine or the trade simulator. Okay, finally, folks. All right, so here we'll look at the Russell, and let's look at what's happening with the Russell. Here's the June end of month condor as a theta trade. And we'll look at this here. So here's the call spread you're selling, the put spread you're selling. Here's the current market price on the Russell. What's that, around 20, what are we at? Just over 2,000, 2,100 or so. But you can see the cash required is much smaller, just about $1,200. Profit potential, 7,650. Targeted return on cash, your targeted annualized return, and you're selling these puts and these calls here, and the deltas are actually even lower. So 8.28 and 5.61. So you have over a 91% probability and over 94% probability that these two puts, these calls and puts will expire out of the money. So we'll go ahead and jump into, we'll trade 5 of these. Let's do 6 just to be different. So your cash required, your profit potential is listed right here. And that is the end of month Russell Iron Condor. So there you have it. Just that simple. Let's see if we can get to the dashboard quicker than last time. And then we'll look at the Dragonfly Russell. So this is the July week 1 expiration. All right, so here is your graph. Here's the call side of the Dragonfly on the Russell, and then the put side here. So the market's trading here, and it has this wide margin of error between the short calls and short puts. And you'll notice the cash required on the Dragonfly is 2269, and the profit potential is 231, and your T-Rock, as we call it, and the TAR are listed here as well. And then you can see the puts and calls on the Russell, in this case, are 12.2 and 12.6. So you're looking at around 88% or 87% probability that these puts and calls would expire out of the money. And instead of clicking through, let's just go ahead, keep this in mind. So this is the Russell Dragonfly. So you can use margin of around 2270 to a maximum potential of 231. Now, if you look at an E-mini S&P Dragonfly, and that was the week 1, we'll use the same expiration, so it's apples to apples. So you can see here the cash required is 4744. What is that? Over $2,000 more, and the profit potential is nearly the same in terms of comparing it to the Russell Dragonfly. So that's sort of the anomaly I wanted to point out. The Russell Dragonflies now are generating an equivalent maximum profit potential, but your cash required with the Russell is, I would say, close to 50% less. So that's why I wanted to point that out. And we kind of like the Russell right now. It's being overlooked. And I'll go ahead and show you a couple other trades here on the simulator. Here's the trade simulator, and I've loaded a couple of these here to go back in time. And this will sort of help explain some of the differences between the condor and the dragonfly, and how sometimes the dragonfly can offer some benefits. So here's a condor. You could use these buttons here to go backwards and forwards. And you can see, let me just squeeze this down here. You can see the whole screen. You can see everything is green. That means good, do nothing. The trade's still not positive yet, which is, or at least the P&L is not green, which is normal because theta decay hasn't had a full time to work. Now you can see it's moving higher and higher, getting closer to your upper boundary, but still ThetaTrader says do nothing, yellow is fine. Then it turns green again, do nothing, and time is going by, and then it turns blue. So that's your profit taking signal, and we can automate this, folks. So I'll show you here in just a minute in your account settings where if it turns blue, you can automatically have an order generated to close out that position and take it off the table and move on to something else. So that was the week 4 expiration condor. And then here's the week 4 dragonfly. So let's just run this through. So you can see the market doing the same thing, just with a different trade structure here. And it turns blue, but it turned blue, gave a profit order on August 4. And if you compare it to the dragonfly here, I'm sorry, the condor, you had to wait till August 11. So, almost, well, basically a week. The dragonfly matured a week earlier or a week prior to the condor. So you were able to get an order placed and hopefully close that position out with the dragonfly. And again, that's because the dynamic here, you own this particular call and just end this put here. And it creates a much different characteristic in these certain circumstances. Here's another condor. Let's see what happens here. on the S&P. So it's getting closer here to your upper boundary, and then it turns red. So you end up taking a loss on this trade. If it turns red, you can automate that as well. So an order is placed to close out that position. Too much risk, take your loss and move on. So that's your June end of month condor. So here's a June end of month dragonfly. So instead of doing a condor on that day, imagine you had done a dragonfly. Look at that. You had a profit taking signal. So the dragonfly, again, it matured and it sort of ripened, as we call it, enough for the algorithm to say, get out and take your profits, compared to the condor, which ended up at a loss. Here's another condor example. This is the S&P again. You can see it's turning yellow, so elevated risk, but still do nothing. Then it turns red. So on January 25th, you had a red RTI, too much risk, get out, take your loss. So now we'll look at that dragonfly for the end of month expiration. Again, instead of doing a condor on the January end of month expiration, what if you had done a dragonfly? I kind of forget how these turn out, but let's find out. There you go. So you get another profit taking opportunity with the dragonfly that the condor did not offer you. So we like the dragonflies. Of course, the dragonfly can still have a loss, but compared to a condor, there are times when it's going to be more robust. But the trade-off is it's going to have a lower profit potential, is one way to put it. So here's how you go to your settings in ThetaTrader, and then you click this, activate your risk manager, activate your profit directive, save the settings, and that's all you have to do. So when it turns red or blue, that's all automated, and then that will take care of the orders for you. There's also our proprietary research here called TradeScope. We generate this every day for our client base, so you can look at some of the technicals on the graphs here, but also we look at some of the narratives here with the outlook for the future, and that's all part of your ThetaTrader account. Also something here called the daily trading summary, and this generates all the activity from Asia, from Europe, here in the US, and then what to look for moving forward, any economic reports on the calendar. And that's a real nice synopsis. People like that because it's really concise and easy to get through in just a few minutes. So that's also part of ThetaTrader. And then there's also videos here, educational videos on how to place trades, options, if you need a review on things. So these are all available here. And looking back, let me just go back here and magnify this one more time. We'll go ahead and just, since I think one more thing here. Here's how to look at your open positions, of course, right on the dashboard, like we are here. You can see your open short positions and your open bought positions. And I mentioned all the colors. That's all available here under the help file. And you can read the glossary of things, but also the colors are all described right here. We don't have time to read it all, but just want to let you know it's all listed here so you have an idea of what to expect. And then your closed positions you can look at here on one page. I'll show you that. And you can filter, by date and by market and whatnot, but I just have it here set up to look at everything. You can see here total on the page, there's 20 trades, 15 winners, 5 losers, your net result. And this is interesting. 15 short option spreads, or something similar to a condor or a dragonfly. 14 winners and 1 loser. That's the result. And then here's your long options or your bot spreads. 1 winner and then 4 losers. And that makes sense mathematically because those are lower probability outcomes. And if you wanted to go back in time, maybe you want to look at this dragonfly and sort of refresh your memory on when you placed it and what the market looked like. We've highlighted it, we've clicked it, and then you scroll down and you can see here it was placed on March 18, and you can see the RTI all along the way, and then you can see here the profit signal, and then that's when it closed the trade out. So you can kind of go back in time and look at all that. All right. I think that's a good overview of the ThetaTrader platform. It's very intuitive, user-friendly, very simple to use, and that's all by design. And then real quickly, I'll just show you that clearly we looked at just a kind of a condor and dragonfly, which are more non-directional in nature. You could have a bit of a bias if you'd like, but I just want to point out too that, again, if you're really bullish on something, maybe you're bullish the NASDAQ, and maybe you want to just buy some call spreads or outright calls, or buy some call spreads, or you could sell some put spreads here. So there are directional plays you can make. And here's something called a bull hedge that we developed in terms of the name at least, but it's really simply put a strategy where you, in the case of a bullish hedge, you buy an out of the money call spread and you sell an out of the money put spread to finance the purchase of it. So here is what it looks like on a graph. So you're bullish, so you buy an out of the money call spread, but to pay for it, you sell an out of the money put spread. And that's kind of what it looks like. And depending on the pricing and all, a lot of times you can do those for no cost. We'll go ahead and do 3 of these. You can see I'm just randomly placing orders. So there's really no thought behind what we're doing here during these demos. So don't make too much out of the results I showed you, but it is probably accurate to say that any of the short option strategies over time are going to have a more favorable outcome in terms of at least the number of winning trades. All right, very good. Well, let me switch gears and get back to the presentation. I want to show you what is maybe the best feature of all. Okay, takes just a second here. If you have any comments or questions along the way, do feel free to jump in and add them at any time. And I probably will answer a lot of them as I'm going along. But this, I think, might be the best feature of all. These are the trade alerts. So these are things, trade alerts, unlike anything you've seen before. Normally you receive an email or a text message, and then you have to log into your account somewhere and copy everything over and try to copy what the trade alert says. But these are one-touch responsive, and you simply touch accept or reject on your smartphone or even via email. There'll be a link, and then everything is transmitted back to us. So these are what we call live or integrated alerts with your AltaVest account. You touch accept and the order is placed. And here's an example. You can see you'll get a little note on what the trade is. You'll see a graph. I should probably have a newer updated example, but it looks similar, though we do have some new features. Excuse me. And you'll notice your premium collected here, the amount of cash required, and the quantity is pre-selected for your account. So each alert you receive will be tailored for you and your account in terms of the sizing, meaning the quantity, and the trade itself. You're not going to receive alerts if you already have the same or similar trade. You can see here the days till expiration, targeted annualized return. And if you like what you see and you want to place the trade, you simply touch accept, and that's it. And then we handle the rest. And then one thing I didn't point out, and it's not here, but you can actually change the quantity on the alerts, or even in ThetaTrader. When you get an alert via email or text and you see it on your screen, you can change the quantity if you want to do fewer contracts or fewer spreads. So there you have it, folks. People love the intuitive interface and the ease of use. And if you'd like to become a member and work with us, we'd love to have you. Some of you probably have been watching the demo account for a while. Some of you are probably new to this, but either way, to become a member, you get everything we just talked about: the ThetaTrader software, which includes the Theta Trades, the RTI, the simulator, valued at over $3,500, and the one-touch alerts. Remember, accept or reject. It's that simple. These alerts are integrated with your account. You don't need to do anything with trying to copy any orders or any of that nonsense. Those alerts valued at over $4,400 a year. So your ThetaTrader membership, again, includes the software, which includes the alerts valued at over $8,000. And then, of course, you have private coaching. We're experienced, we're licensed. You can work with us. We'll chat with you on the phone, share screens. People love that. You'll have kind of a co-pilot that can walk you through things, talk about your trades. $7,500 value, probably undervalued. I know people are paying $25,000, $50,000 a year for coaches and systems and things. So again, it all adds up to over $15,500 in value. And to get a little bit corny, sort of like an infomercial, here's that extra bonus. We don't want you to forget about our proprietary research with TradeScope and the daily comments. $2,900 value, but only available to our client base. And we mentioned those online video tutorials. Those are very, very helpful. So you add up everything, and over $18,500 value for the ThetaTrader membership. And of course, it's not going to be that much. And we did used to offer ThetaTrader in live in-person presentations before the pandemic outbreak. And that was the rate, $4,000 during live in-person presentations. But of course, we'll do a lot better than that. And we often have this at $997, but we're going to do something here called the early bird special for the first 8 that sign up before Friday night. It's only $597. And here is the link, cf.altavest.com/TT. Do take a picture of this or a screenshot. And that's my direct phone number. And there's our email address. So you're welcome to call, email, and I'd be glad to help you out. There's the link there. And there's a money back guarantee on that as well. So if you sign up and something happens and you have to cancel the membership, let us know in 30 days. We'll just refund that. There's no issue in doing that at all. And there's also a free membership available. If you have an account of 50 to 100,000, you get a 50% rebate on your membership. And if 100,000 plus, then we'll just rebate that entire membership amount. So people like taking us up on that. Now here's some FAQs. Let me see if I can, if there's anything I haven't answered already, if anyone's made any comments or anything in the chat box with any questions. Let's see here, and I'll just move forward. Tax efficiency. Keep in mind, trading futures options is tax efficient. And what do I mean by that? Well, they're treated differently by the IRS in terms of the profits. They're taxed at a much lower rate, where 60% of the gains are taxed at the capital gains rate, which is usually lower than your personal rate. So here's an example with individual stocks. You might get a 12.6% return, but with futures, you'd have a 14.64% return, a tax savings of over $2,000 in this particular example. But do contact your tax advisor. And also, there's no more itemizing. So you get a 1099 with your P&L for the year, and that is all you need to do. There's no wash sales or anything like that. But do check with your tax professional. An IRA, yes, we can do that. Contact us for details. People like having those accounts. And this is talking about why trading the E-minis, S&P 500, but it really applies to the E-mini family. But the E-mini S&P 500 is probably the more liquid, but it's liquid, efficient, cost-effective, uh, deep liquidity, a wide array of maturities. This is from a few months ago, but 1.6 million contracts per day. That's a lot on these equity indexes. And the E-mini in particular, they trade 3 billion notional per day. That's over 10% greater than the notional value traded among the 500 underlying index constituents. And it's 10 times the value traded across the S&P 500 ETF. So basically the point of this is that's where your volume is on the S&P and the minis and these indexes. And we talked about the Russell and the NASDAQ. Those would be to a lesser degree, but still they're very, very deeply liquid. Superior execution, according to the CME group, $4 to $15 per contract, a cost savings compared to SPX. Tighter spreads, large market share. So you have densely packed strike prices, 100 annual expirations, you get granularity and coverage. And so what does that mean? What it means is when our algo is looking for the strikes it needs to build out the trades to meet criteria, it's going to find calls to sell and puts to sell, and then as time goes by, it's going to find another set of calls, another set of puts, and as time goes by, so on and so forth. So you need that availability of strike prices. If you try to do this type of thing with a typical stock, you just can't do it, especially with a dragonfly. So here's a big advantage with us and the dragonfly. So that six-legged dragonfly, and you saw how we placed it as one order. So all six legs are packaged and they call it an object or one trade. So that's only available with the E-minis and only through the ThetaTrader platform. So one order placed as one trade at one price. So you don't leg in as two separate orders or two separate spreads. And I've tried to do it on other platforms, and you have to break it up into two separate orders. So it's very inefficient. You have to leg in, leg out with two separate orders. It's kind of a not ridiculous. So again, these ThetaTrader makes these E-mini options trades available to you, and they're really sophisticated option strategies compared to, say, the retail stock options trader. Here's this woman again. Most retail investors only have access to the most basic call and put options, and they don't have access to sophisticated spreads. So remember, the pros are not option buyers. That's how rookies trade. If you only buy stock options, time or theta is working against you. And this is where the that woman's I quoted her from this link here on YouTube. It's a good video, accurate. Yun Lee is her name. So, and why is this popular trading strategy so risky? Well, what she's referring to is just buying options. So the appeal for retail investors to buy options is that they're much cheaper, but potential for profit is not that high. In 2021, 11% of Robinhood's active users made an options trade, but of that 11%, fewer than 1% actually made a multi-leg options trade. So what she's saying is basically nobody in the retail audience is doing option spreads. And that's really where you want to be. That's the advantage that I think we can deliver, which is providing the platform to make option spreads very user friendly. So you can just follow a couple of these markets that we track: efficient margin, clear cost structure. Remember, these all trade with Chicago Mercantile Exchange on the Globex exchange. It's electronic. Every order is treated equally. There's no payment for order flow. If you don't know what that is, essentially every time you trade a stock, the brokerage firm is not filling the order. They actually sell the order flow to someone else, the third party, to fill the order and provide the execution. And they receive millions and millions of dollars to sell that order flow. And it's because, why do you think the third party is paying for it? Because they can basically capture the spread and fill your orders at prices that are not as favorable. So Robinhood customer orders executed at prices inferior to other brokers. So even they say commission free, and it's not just Robinhood, anyone who uses that payment for order flow, which of course is legal. I don't know why it is, but it is. So none of that with us. Everything is transparent. Your rates are 5.25 round turn all in, and others might publish rates like 2.25. I pulled this off of a big box brokerage firm for futures options, and it looks like it's a lot less money, but it's not, because that's only per side. So you pay that much when you get in and that much when you get out, and then they add more fees on top, and it ends up being higher. So our rates are competitive. Everyone trades differently using ThetaTrader, so performance is different for self-directed traders. Everyone's self-directed, and they make their own decision on what trade to place or not trace or not place. And everything is net of trading cost in ThetaTrader. I didn't make that clear. I don't think I did. So all the numbers and calculations, percentages in ThetaTrader are net of all cost. We suggest a minimum 20,000 account, allow you to have dragonflies and condors and other strategies to diversify within your account. And then why would you want to even do something like ThetaTrader? Well, it's really an alternative, and it may improve diversification and lower portfolio risk. You know, keep in mind the economy, I don't know, it's probably, I've been thinking we might turn recessionary anytime now for like a year, and that's according to the leading economic indicator index, according to the conference board. It decreased by 0.6% in April after decreasing by 0.3% in March, so it's much worse than expected. They say softer economic conditions lay ahead, GDP growth to slow under 1% this year. So we'll see. Here's where we are right now. It is turning up from this really, really weak level, but we'll see where it ends up. So we still think there's a lot of benefits in trading the mini stock index options. Again, you can be directional, you can be more non-directional. It depends on you. You know, we talked about bull and bear market strategies. You don't have to pick stocks or worry about, trying to time things up and down perfectly. That's why there's a margin of error when you sell a dragonfly. We talk about that margin of error. Here's this example here, 750 points between these calls and puts in this example. And then it can save you time. Here's an example of someone spending 10 to 12 hours a day trading. I don't think a lot of us have that time. Let's also diversify your investments. You don't want everything 100% correlated. So that's why we like having exposure to something like this. And what about the economy and the stock market? Sometimes they're two different things. They don't always move in a parallel manner, but it's possible the stock market, even though we're near all-time highs right now, or at them, who knows what happens in the next 5-10 years. You may end up just chopping around, going sideways for decades. And I would attribute this chart, I just forgot exactly where I got it, so please forgive me, but recovery time 19 years, 25 years, 16 years, 6 years, and then it ends in late 21 right here. But it can take decades to recover. If you bought into stocks here, it took you a long time, 25 years, or you buy the wrong time. So yeah, overall, long enough time period, stock market does move higher, but I guess depending on timing, it doesn't necessarily have to mean it's going higher for you if you're in it at the wrong time and just being totally passive. So we like these automated strategies with options. You can speculate or even hedge your stock portfolio. So having a piece in the alternative space makes a lot of sense. So here's the ThetaTrader membership here, just to review everything you just saw and the coaching included. You'll get those alerts here. You get the algo-driven option trades, bullish, bearish, non-directional. You get that trade simulator. People have a lot of fun with that, going backwards in time, kind of like a time machine. You can choose any date, any strategy, any market. You can kind of run through the scenario. You don't have to go step by step. You can just go right to the end as well. And then those one-touch alerts that I mentioned earlier, they also appear on your dashboard, so you can view the alert right here when they're sent out to you. And then on your phone or iPad as well. Just touch accept or reject, and that's all you have to do. So here's that discounted offer. Here's what the order form looks like, just one page. Real simple. That's my email, eric@altavest. There's my direct phone number. Encourage you to call me if you have any comments or questions. I like feedback, good, bad, or otherwise. I know it's a lot of material. Hopefully I didn't, rush you through it too much, but don't want to keep you too long. And let's see if there's any other questions or comments that I didn't see or get to. I think we covered a lot of ground here. So with that said, I will wrap it up and encourage you to give me a call. And if I don't pick up, I'm on the phone and someone else will pick up and just leave a message, or either way, we'll get back to you or send me an email. But thanks for joining me, and we'll be in touch. So have a great day. Bye-bye.